How will we prepare ourselves? I think right now they want a narrative that is somewhat headwind narrative to keep the gold price down while they collect it, and then they have to position themselves whether it happens or not. It's a recognition that gold plays a more powerful role as collateral and trust. Got 8 billion ounces above ground of gold in the world. Billions and trillions of backdoor non-QE, QE happening right now. It's a huge question to answer, but I think the simple fact is, the price action, the signals, the algo traders, the hedge funds, the swaps, I think it's more than just headlines about more conflict. I think it is confusion about what is happening at the COMEX, the CME in London with the deliveries. What will they be able to do to make it a sell-only exchange or reduce paper claims? Is there a new repricing coming in 2026 in the East? How will we prepare ourselves? I think right now they want a narrative that is somewhat headwind narrative to keep the gold price down while they collect it, and then they have to position themselves. Who's going to be the new referee in this soccer pitch? If it's not New York and London, if it's going towards the East, how are we going to prepare for that? I think the fact that Judy Shelton is talking about a gold-backed treasury is more than just optics, whether it happens or not. It's a recognition that gold plays a more powerful role as collateral and trust, and they're watching the East beat us at the game. To catch up, we have to get some of those bullets back. We have to keep the price narrative down. We can use the positive real yields as a headwind story, when in fact, when we look at real inflation, yields are incredibly negative, not positive. That's a way to inflate our way out of debt. It is. But that's not a headline. That's not what the market wants to tell you. It's what we all know. But I think this combination of the moving chess pieces, east to west, west to east, actually, I think the bank's reloading. I think the narrative of hawkish warish and a strong dollar and positive real yields, all of that is affecting the gold price now, but it's a false narrative. That's not conspiracy theory. It's the narrative I would present to reload when I need to reload. And I think that's what's happening.
Yeah, makes sense. It's interesting to see that the gold price is somewhat numb to geopolitical news as well. Like this morning, we've seen MOU been torn up. It's like, okay.
I know.
We're down $50.
Right.
It's like, okay,
and by the way, gold
whatever.
can go down further than this. Don't get me wrong. As we talked about in Vancouver at the beginning of the year, when everybody was too euphoric, was too fast, too high. Of course the CME isn't going to give up easily. Of course London's not going to give up easily. Of course the narrative isn't going to die easily. But I'm not here to say that gold only goes up and to the right from here either. But I am here to say with complete conviction from all of the things I see, it's going to go much, much higher for a few years. Again, priced in dollars, euros, Swiss francs, whatever, kind of silly, but this is the very first chapters of a secular bull market. And if you're an investor for the right reasons, I don't look at the daily price, but there's no doubt. It's interesting, the memo of understanding torn up, gold barely does a hiccup. But gold can be a very valuable liquid asset in times of and if we have a mean reversion in this immortal S&P, gold could sell off significantly then too. But again, for us and our clients, we're just looking at bonds and paper currencies, and that gives us so much calm in this crazy storm.
Well, gold is still fulfilling its role. It's a provider, the last provider of liquidity.
Absolutely.
It's like the last crusader a little bit, right?
Exactly. It's the last honest player on the team.
Yeah, it's like the last store of value. Like, why did Turkey, sell 118 tons of gold?
I know.
To shore up its reserves. So it's still, the properties of gold haven't changed, have they?
Not at all.
Not at all.
Not at all.
Okay.
Not at all.
One thing that's why I've been looking here at my notes is like Eric Sprott said something interesting. I just want to investigate a little bit with you as well. He said there will be a shortage of gold, and he gave some numbers, but overall we don't produce enough. China's soaking it all up.
Right.
Do you see actually like a gold squeeze? Like we've talked about the silver squeeze before, and I don't want to get euphoric or anything about it. I'm just looking at the supply and demand.
Yeah.
Is that a possibility, a gold squeeze?
Think about it. It was a great point. I'm curious to read it and see what he said. But look, we got 8 billion ounces above ground of gold in the world. 7 billion of that is held by big institutional players, central banks, sovereign wealth funds, commercial banks. Maybe 500 million to 1 billion ounces are freely traded in the world. It doesn't take,
Before we dive deeper, if you enjoy fact-based analysis on gold, the US dollar, central banks, and the global economy, consider subscribing. Every week, we break down complex financial stories into clear insights so you can stay ahead of the headlines. Now, let's see why some of the world's biggest institutions may already be preparing for a very different financial future.
Supply and demand still matters, notwithstanding all the trickery in London and New York for decades. Since we went off the gold standard, adding futures contracts to gold was a deliberate Kissinger play in the 70s. We all know that. We've all read the books. China knows it too. And supply and demand will eventually raise its beautiful head again. Natural price discovery based on physical trades. And given the stock to flow the natural scarcity of this metal, and given the growing difficult to measure distrust in paper currencies and IOUs with yields spiking at decade highs across all the big countries. All of this is a way of saying eventually when natural supply and demand, which China is now trying to make more real, it's a beautiful moment of higher and higher demand, higher and higher distrust, and the same supply of the 116 million ounces mined per year. So it's way past the Bitcoin debate now. It is a real, honest, with real property metal whose supply isn't going to increase from a meteor coming from the moon, and whose demand from the biggest players on earth, from the BIS to the Bank of Japan to the Fed, is going to increase. You don't need to be a genius to see the converging forces for gold longer term. And no, it doesn't mean gold only goes to 10,000 next week. Yeah. But again, when my grandmother bought 400 ounces, it was for a few $100. It's worth $2 million today. It's important to keep the larger history in mind. Ray Dalio, Egon von Greyers, myself, you, we all know you need to understand math and history to stay calm in gold. Mining, speculation, equities, embedded leverage, fantastic. Very different mindset, respect it. But the spot price still matters from cost of production, so it's still relevant. But for boring guys like us who just don't trust paper currencies, this is a fantastic time to be buying right now. Fantastic time.
I was just speaking with one of the bullion dealers here across the street. He said, Kai, or across the hall here. Not across the street. He's like, Kai, he's like, our market is the only market when price goes down, people don't buy more.
Right.
They wait for confirmation. They wait for higher prices to see maybe the trend.
Yeah.
Why is that?
I think I would take it. I think in every asset class, hard assets, risk assets, even real estate, I always see people buying tops and selling lows. Always. We would like to think that that would be different for those who understand history and math. We have some very sophisticated clients coming, they're not all Swiss, and they are buying at lows. Yeah. They do have that massive conviction. But even among the most sophisticated class, there's a nervousness, there's the psychology. Rick Rule calls it irrational versus rational. But I think the most rational investors in the space are making the calls to buy now. If anything, they're waiting for it to go a little lower. And that, again, is a mug's game. But if I'm looking 10, 20 years out, if I'm thinking my grandkids, like my grandmother thought of me, I really don't worry about whether it's at, I know this sounds smug, whether it's at 51 or 41 is irrelevant when I see it at 15, 17, 20. And I'm not going to measure that in a paper currency anyway. How many barrels of oil, how many pieces of real estate, how many real things can I buy? Not measuring in a currency that I've lost faith in a long time ago.
Is that reflected here in sentiment as well? Like when you talk to people,
have
they thrown in the towel? It doesn't seem like it.
No.
Of course, we're in our bubble.
We're in a bubble
course,
here,
right?
for sure.
So
we're in a bubble.
I'm just curious, what you're picking up. I have yet to hear from anybody that they're negative about where
honestly, I've talked to people from Hungary, from Mexico, from Switzerland, from Dubai, from France, from the UK, from Australia. They're all pretty comfortable with this right now.
Yeah.
And they're not panicking. In fact, they're here because they see, especially in the equity side, massive valuation right now. Because it's been following the tape, really good cash flowing companies with the same fundamentals are 40% off right now. So, and they are ready for volatility. When it comes to physical gold as a wealth preservation asset, we're seeing the same things. Smart money, comfortable money, who gets this through math, they're buying. Yeah. And if anything, they're maybe hoping it goes on sale a little bit more right now. But again, I talked to Ronnie Sturfula, we all know the longer story here. But we, like the clients, had to be patient through these irrational moments. Luckily for most of us, most of our clients, we're preaching the converted now. They're calm. They're calm in the storm.
What are you looking for the rest of the year? We have in the U.S., I'm just, I don't want to put words in your mouth, but, new Fed chair.
Yep.
A couple more, maybe even rate hikes. Like, what are you looking for that could direct or give us a bit of direction here?
Look, the new Fed chair is another classic example of headline price action versus what's happening behind the scenes. He's completely violating the Basel III Accords. He's going to allow capital reserves to be remonetized, releveraged. That's $1 trillion in backdoor liquidity directly into the banks. More leverage, more risk. That could be risk on. It's business as usual. Whether Powell, who is the most dovish, supposedly hawkish member, and Warsh, who's supposedly hawkish, is actually just gave more money to the banks than ever before. It's what people can't see, whether it's the Treasury General Account, the reverse repo markets.
At this point, notice how the discussion shifts from daily gold prices to the broader financial system. Whether you agree with every conclusion or not, understanding how liquidity, central banks, and investor psychology interact can completely change how you interpret what's happening in today's markets.
Guaranteeing big to fail banks' treasuries at 100% par rather than 70% loss. or whether it's supplementary leverage ratios, or what these Basel III regs he just violated mean. Boring, boring, boring. All I'm saying to listeners is there's billions and trillions of backdoor non-QE, QE happening right now. He can put a hawkish beak and tape it to his face. He, like any other central banker, has to debase. They have to revalue their gold, debase their dollar, and reset into a digital currency issued by a tether. It can even be Walmart. It can be Visa, MasterCard, or now DoorDash. This 140 companies that just agreed to a stablecoin to absorb treasuries. There's all kinds of tricks and fugazi, but the Fed is still liquefying the banks to keep them liquid so they can keep lending into a bubble. And that bubble can last 10 more minutes or 10 more months. It's insane. We are so hyper-financialized. Our equities market is 2.5 times our GDP. We can't afford a recession or a mean reversion because we can never repair it with our Fed. We can't, without killing the currency. So we are living in a very fragile time. And to answer your question, it's Dickinsonian. It could be the worst of times or the best of times. It all depends on when this massive, overvalued by every metric, liquidity-driven nonsense blows this S&P. Or we just nationalize it at the expense of our currency. And none of us can predict that. Or what happens when another memo of understanding gets torn up. Or some other headline. When you and I met in Vancouver, did we know? We kind of thought there could be problems in Iran. Did we know there'd be a super Silver Friday 3 days later? We're little pawns in the machine. We just got to be patient pawns.
Exactly. We can just track and discuss it, of course. But it's like, I'm just trying to figure out, like, plumbing-wise. Like, you just touched on stable coins.
Keep liquidity, create the new oil and stable coins to absorb some of those unloved treasuries. If they can sustain that and keep the narrative positive, it's risk on. Because the markets are Fed-driven. They have nothing to do with supply and demand. The days of Benjamin Graham are gone. Jeremy Grantham, he knows this. Gundlach, he knows this. It is not a normal market anymore. I mean, look at SpaceX at 100 times earnings. Nobody cares. Look at the IPOs. Nobody cares. So until something hurts us, or until we have a real liquidity event where we just can't do it, and we have to admit to QE, this nonsense can continue. It really can. And right now, the narrative is tech's going to save us, even though they're a little overvalued. You know, Warsh may be hawkish, but what's another rate hike to us? Because that'll just force QE down the road. The Fed has our back. The only back the Fed has is the shareholders to the Fed, the shareholders of the banks, and they got to keep liquidity in. We can see deflationary forces, but they're going to keep liquidity for the banks until that becomes unsustainable, and no one can time it. But I think it's risk on for now in a market that has lost all rational sense, all valuation. It is Charlie McKay's The Madness of Crowds. It is Hussman's moment of craziness, and no one can time that.
I've got to quote something here. I got to find it real quick because I saw it this morning. Bloomberg sent it out, and I hope I didn't delete it. Where is it? It was, I think it was in the daily briefing of Bloomberg this morning. And NVIDIA is now cheaper than Hershey.
Yeah.
Because NVIDIA came down price-wise, and now it's cheaper than Hershey on a valuation basis.
You gotta love it, too.
Like, how do you wrap your head around that?
Well, think of companies that have actual pricing power, that they can do whatever they want, and they're still gonna be buyers. Chocolate. That's more addictive than cocaine, literally. Chocolate, Pepsi, Coke, these companies have pricing power. The Sin stocks, the beverages, Coca-Cola, Pepsi, they have pricing power. Healthcare, defense has pricing power. And NVIDIA is as Jeremy Grantham said, it's like it's selling shovels in a gold rush during the tech boom. But they can be, winners today and losers tomorrow. But those boring things like chocolate and stable, free cash flowing, price buying stocks, they're going to be winners no matter what. Defensive stocks are going to be winners. That's getting into the markets. It's also important when you look at this market, since the S&P's peak in Q4 of 21, stock market's up 60% today. But in gold terms, priced in gold, it's down 40%. So again, it's what are you measuring these returns in? This is where you got to come back to earth. If you're measuring your wealth in paper currencies in your 401k or in your portfolio, up 60% since 21.
Perfect.
But in gold terms, it's down 40. Think about that. Just think about that. What is real money? And the system, and the international system, not just you and I, is rethinking what is money. And that's why gold as collateral is way beyond just gold as a wealth preservation asset.
This is where the bigger picture comes into focus. The conversation is no longer just about gold. It's about how investors define wealth, trust, and purchasing power in a rapidly changing financial system. That perspective may matter far more than any single market move.
It is part of a systemic change that we're living in right now.
Like, I feel like I'm asking a question that you've already answered three times today. It's really, it's like, what do you want the investor like to take away from your keynote? I know you're speaking here.
Right.
Like the one thing is like when they walk out of here, it's like, okay, this was great. Like Matthew just said this. Like, what's the one thing?
The one thing is the title of the presentation is Why Gold is a Necessity, Not a Debate. And the one thing I want them to understand is math and history. And when you're measuring your wealth in euros, dollars, Swiss francs, understand how that paper money measures against real money, dishonest versus honest money, historical money versus Johnny-come-lately money. And believe it or not, our dollar isn't that historical. It's just another system of paper ruination, and it's very familiar to any of us who know history. So I want them to take away, it's very proud to work hard and earn a living, whether it's in the markets or something else, and measuring your money in a checking account. But value that checking account and that money against real money and see how it plays out. And, look, over the last 25 years, the dollar has lost a lot versus gold. It's just empirical. Just look at that. Since 1971, it's lost 99%. This isn't a gold bug meme. It is how do you understand the way you measure wealth? It's not a gold bug case anymore. It's that simple. And yet there's a lot behind it, but that's what I want to take away.
Has gold gone mainstream though?
Never. Not yet. There's not because people are stupid. It's deliberately been ignored for decades. In the industry I come from, you weren't allowed to talk about it. It's never taught in the schools. It is the anti-hero for the dollar. So of course it's not going to be in the Pledge of Allegiance. No. Never. It is in Article 1, Section 8 of our Constitution, though, because Thomas Jefferson said this. He knew this. And, Andrew Jackson said in the mid-1800s, central bank will ruin our money. He said it will be the prostitution of our government at the expense of the many for the benefit of the few. And that's exactly where we are right now. Worst wealth inequality in our history. I'm a capitalist all day long. We have feudalism. 90% of the wealth, the top 10% own more than the bottom 90%. That's not capitalism. That's a problem. And I'm part of that system, and it's a problem. It's not good for us either.